in the Price Action Roadmap video. Following the roadmap, welcome to the third video in our Price Action Roadmap series. In the previous videos, we've covered essential candlestick patterns, such as the hammer candle, bullish engulfing candle. Today, we'll continue this journey by diving deep into the inverted hammer and shooting star candlestick patterns, two critical tools in basic price action analysis. Let's start with the shooting star pattern. This is a single candle pattern that typically appears during a short uptrend when the price is near a resistance level. At this critical juncture, the candle forms at the top level, which we identify as a shooting star. Here's what happens. Initially, buyers push the price up, creating a strong upward move near the resistance area. However, sellers then step in, reversing the price direction, leading to the candle closing below its opening. The result is a candle with a long upper wick, indicating a lack of fresh buying interest at this level. The resistance is too strong for the price to break through, which attracts more sellers, and the price closes lower. After a shooting star forms, if a bearish candle appears and closes near or below 50% of the previous green candle, it signals a potential entry for a short trade. You can place your stop loss just above the shooting star's wick. Psychology behind the shooting star. Let's break down the psychology of buyers and sellers here. Buyers who entered earlier have seen significant profits and may start booking those profits as the price reaches the resistance area. At the same time, new buyers may mistakenly believe the resistance will break, leading them to enter long trades, but since the price is already near a strong resistance, sellers seize the opportunity to sell at higher levels. As selling pressure increases, the price declines, causing the candle to close below its opening. When the price moves below the level of the previous green candle, the stop losses of buyers are triggered, leading to a sharp drop in price. The shooting star thus acts as a bearish reversal signal. Let's look at an example. As the market opened, the price surged, forming strong bullish candles, and then consolidated in a range. After a strong bullish candle broke out of this range, continuing the uptrend. However, at the top level, the price faced resistance, leading to the formation of a shooting star. This was followed by profit-taking by buyers and the entry of sellers, creating bearish candles on the chart. However, since the previous green candle's low wasn't broken, fresh buyers attempted to push the price higher again but failed. Sellers increased the pressure, pushing the price below the swing low, causing panic among buyers, who then exited their positions, leading to a sharp price decline. Tips for trading the shooting star. When trading such patterns, avoid entering a full trade position until a candle closes above the resistance level after a pullback. The chances of a breakout failing are high if the price is near a street. Understanding the inverted hammer pattern. Now let's move on to the inverted hammer candle. While the shooting star forms at higher levels after an uptrend and signals a bearish reversal, the inverted hammer forms at lower levels, signaling a bullish reversal. If you imagine flipping a hammer candle upside down, you get the inverted hammer. When the price is in a short-term downtrend and near its support level, sellers may start booking profits, causing the price to rise. However, the price closes lower after facing resistance. Seeing the weakness in selling, buyers enter the market and close the next candle at higher levels, causing sellers to panic and exit their positions. Fresh buyers also enter near the support level, pushing the price higher, leading to a trend reversal. Example of the inverted hammer pattern. After a small uptrend, the market faced rejection at higher levels, forming a shooting star in the second half and closing lower. The next session, the price attempted to rise from the previous low but failed, forming an inverted hammer on the chart. Buyers tried twice to push the price up, but sellers pushed it down again, preventing a break of the lower level. Seeing the weakness in sellers, buyers entered long trades, expecting the market to take support from the support area, forming a big bullish candle on the chart. Sellers who anticipated a breakdown found their stop losses at risk due to this bullish candle, causing them to exit, which further fueled the upward movement. When using candlestick patterns in price action, always remember that these patterns work best when they align with key support or resistance levels. If the inverted hammer had not formed near a support level, it would not have reversed the market trend on its own. Therefore, whether it's the shooting star or inverted hammer, these patterns need the support of critical levels to function effectively. I encourage all traders to practice these concepts on charts to better understand them. In our next video, we'll explore the evening star candlestick patterns. If you found this video helpful, please like it and subscribe to our channel. Thank you.